What's happening, traders? Welcome to another video. It's Emmanuel from LiveFree Effects. Today, we're going to be talking about how to scale your trading account using money management. Money management is a secret method that is overlooked because what a lot of traders learn when it comes to, money management, or they think what money management is risk management, right? Because we learned the 1%, the 2%. But it's completely different, right? And I'm going to be talking about the industry standard in terms of, what they talk about from a risk management standpoint, how you can grow your account that way. And I'm also going to be talking about a method that I learned that was extremely beneficial to me in my trading that really opened my eyes to the power of money management and position sizing. And in this video, I'm going to be giving it all to you. This is something that is also featured in my course, Mastering the Story of Price Action, in the money management section. That is there, and I'm giving you a portion of that. Hope you enjoy the video. Let's get right into it. When it comes to scaling your trading account, one effective way to do that is through money management, but not the money management that the industry has taught you, right? We're going to be diving into a different component of, money management that is not talked about in the industry yet. Before we get into the core of this video, one of the things that I want to cover is, give you an understanding of what is money management. If you're a seasoned trader, you understand money management, you might understand risk management more. Money management is a critical factor for successful trading because it targets the bottom line, which is growing the account/capital in your trading. It focuses effectively on minimizing losses, maximizing gains, and increasing the account capital. The components of money management are account size, risk to reward, position sizing, and monetary goal. And what you'll notice when you look at money management is it has multiple components. It's not just like, risk management, because a lot of traders mistake risk management for money management, right? They're two different things. And in the next slide, we dive into risk management. Risk management focuses on mitigating the potential risk we encounter in our day-to-day trading. It's an important component in trading profitably. It also deals with a critical aspect of trading, which is the fact that we deal in probability, not certainty. Ways to manage your risk: know your appetite, cut your losses, know your plan, and stick to it. Accountability. Accountability is, you maybe having someone that you reach out to that keeps you accountable for the risk management that you have put in place. So risk management is a component to overall money management. Now, if we're going over to the strategies that you can use to build your trading account, we're going to be taking at two particular strategies. And the very first one is the standard in the industry. So the standard in the industry, we call it fixed fractional. So is a form of money management that factors your overall account equity and you risk 1 to 3% per trade. So as an example, let's say you have an account size of 10,000. You are risking 1 to 3%, $100 to $300 per trade. So that's something that as a trader, because that's the standard in the industry. Everybody tells you risk 1 to 2%. But this has its advantages and it has also disadvantages as well that I came to realize in my own trading journey that, hey, Emmanuel, this particular strategy or money management strategy is good, at certain points and not at other points. So when it comes to trading the fixed fractional, some of the disadvantages and advantages are, the advantages are simple to use, simple to understand, which is why it's the industry standard. It is very beginner friendly. It is very effective with traders with large capital. So imagine this, you have $100,000 in capital, you risk $1,000. That's just 1% of your trading capital. That's pretty good. So that means that if you are risking 1% to make 3 to 5% per trade, depending on your risk to reward, you're still going home with $3,000 to $5,000, per trade if you get that, right? So you're making substantial amounts of money still. But for a trader who's coming into the market with lower capital, what are some of the things that they will experience, with using this method? Your position sizing resizes with each trade. So recovering from a losing streak is much harder. And this is the one thing a lot of traders don't understand, that when you're using this particular money management strategy, has its advantages and disadvantages. And to me, this was one of the biggest disadvantages. In order for me as a smaller trader, trading with a smaller capital, looking to grow my account because that was all I had, how do I recover from a losing streak when every time I take a loss, getting it back is almost 2 times harder, right? Because if you take a loss, you lose 10,000. You have a $10,000 trading account. You take a loss of, let's say, maybe you're risking 3% on your trade. That's $300, right? You take a loss. Now your account is down to $9,700. You have to risk the equivalent of that, right? Which is going to be a lot less than what you initially risked in the first place. So the more losses you take, the harder it is for you to make more in terms of profit. So it takes time to see any major growth in your account, and it's also not effective for traders with smaller capital, right? So this is the fixed fraction now. This is the standard in the industry right now. And if you're a trader with a larger capital, this is something that I, say, this is cool. It's cool. I recommend it. But if you're a new trader trading, with a lower capital, with a smaller capital, one of the things that I found that worked for me was going over to a next one, which is the fixed ratio. The fixed ratio is mainly designed for options and future contracts, but it can be used effectively in the Forex market. Like many money management strategy, it increases your lot size as your account grows. So the components to the fixed ratio is your lot size, which is, the amount of lots that you're gonna be trading and starting with, right? You pick a lot size, your account size, you pick a lot, okay, this lot I'm going to be starting with. And then we have something called delta. The delta is the amount of money that needs to be seen in terms of growth or profit in the account for you to increase to the next lot. And this delta doesn't change. It stays the same. We're going to be talking more about that. Profits, equity steep, account size. So if we go over here, going over to some of the advantages and disadvantages of trading the fixed ratio money management strategy, the advantage is more impactful results with smaller capital. A lot of you guys coming into the market right now have small capital, right? You don't have the 100,000, the 50,000. And this strategy that I found for myself when I picked it up in my trading journey to be more impactful, because it was very hard for me to stick to the 1%, 2% and really see some substantial growth in my account, in my small account, without having to over leverage it. And that was one of the things I was trying to avoid, because you never know, you over leverage your account and it's done, right? So it's more impactful results with a smaller capital. As the account increases, the risk decreases, which is ideally what you want in the first place. Can be used effectively to grow a smaller account, or really any size account as well. If you can use it to grow, to scale a small account, you can also use it to scale a large account just by following the same approach. Can be optimized for more aggressive or conservative approach, which is something that you're going to see on the next slide, using what we call delta, right? And the delta is simply, the higher the number, the more conservative it is, the more profit you have to make in order for you to get to the next level. But the lower that number, the more aggressive it is, right? So advantages requires a bit more effort to understand. Some of the best things in life, take time. And this, you might have to watch it once, twice in order for you to understand it. But once you understand it, right, you understand it. You'll be risking a larger amount in the beginning stage, but you never know when your strategy will underperform. And that's the one thing with this is initially when you first start off, you might be closer to like the 4 or the 5% initially in terms of your risk. But as you make more profits and as your account continues to do well, right, that accounts, like that amount, or the percentage significantly decreases. But you can also change that based on how conservative or how aggressive you want it to be. What you're going to see here is the fixed ratio formula, the fixed ratio chart. We have the equity, we have lot size, we have delta, and we have profit. To give you an example, let's say we start for we start with $10,000. $10,000, it's going to take you 9 steps in order to get to $122,000. And this is what I call proper money management, because proper money management allows you to see the mathematical equation. It's going to allow you to go from one level to the next level. And there are very few money management strategies that allows you to lay it out like that. You can easily see the step from a money management standpoint that if you follow this guideline, right, this is going to be the particular outcome that you get. The fixed ratio is just that. So let's say for equity, you have your equity 10,000. You say you're going to start with the lot size because a $10,000 account can handle a 1 standard lot size. Maybe you might say this is a little too aggressive. You can change this number to 0.05. So that would be, half of 1 standard lot. The delta that I picked is 2,500. So in order for me to get to 2 lots, I have to make 2,500 in profit. And when I make 2,500 in profit, I increase incrementally to 2 lots. And when I get to 2 lots, I times that by the 2,500 delta, which will give me $5,000 in terms of profit. That's what I need to make, $5,000 in terms of profit, in order for me to get to 3 lots. And as you can see here, what this would do is it shows me every step of the way. And if my account falls back to 12,000, I go back to 2 lots. If it falls back to 10,000, I go back to 1 lot. That's essentially how it goes. And you essentially do this process all the way, by the time you get to, 100,000, you're trading at, 9 lots, right? And you're looking to essentially, make 2,200 9 times, which is 22,000, right? But because your lot size is a lot bigger, you are able to make a lot more money now, right? So your lot size increased with your account. This delta can be changed based on your trading personality. If you're an aggressive trader, you can change it based on if you are a conservative trader. So if you're a more aggressive trader, you can change it to, let's say, 1,500. So that's all you have to make in order to move up to the next level. If you want to be aggressive, you can lower this number. If you want to be aggressive, you can increase this number. Ladies and gentlemen, this is one way that I have found to literally increase your overall account, to scale your account in a meticulous manner, in a manner that literally lays out all the information for you. I recommend that this is something that you back test before taking it to a live trading account. Don't just, Emmanuel said this. Back test it for a little bit. See how you like it. See the difference between this strategy and the 1%, the other money management strategy. And whatever questions that you have, feel free to let me know and leave a comment down below and I'll get to it. As always, I'm cheering for you. I wish you nothing but success. And once again, I hope you're out there living free. Cheers.